Hi ladies and gentlemen, this is Game of Trades, and this video will be explaining in detail why the stock market is currently overvalued. Now, if you've been following me for a while, you'll know I believe that we are heading towards the end of a long-term debt cycle. And I'm going to show you exactly what I mean. This is a quick template of the long-term debt cycle. And this concept is what creates bull and bear markets throughout history. The shorter term debt cycle creates those shorter term 6 to 10 year bull markets, and the longer term debt cycle spans over around 80 to 100 years, and it basically consists in an accumulation of the debt over a long period of time and then a reduction in the debt over a very short period of time. And again, this happens around every 100 years, and you can go back in history around 100 years ago. There was the Great Depression, a huge period of deflation, but the debt went down. And we can actually see a chart that illustrates this. This is the total credit market debt as a percentage of the GDP. It's basically the debt we have in our economy. And you can see this chart is quite impressive. It goes back to the 1900s. And you can see this is where we were in 2008. The debt has actually increased since, but I wasn't able to get such a beautiful chart going so far back. But you can see where our debt currently stands at right here. And this was the Great Depression. And you can see how this can actually be put into a cycle. If you go back in history, this cycle repeats over and over again. This is the accumulation of the debt, and this is the repayment of the debt. And we are likely to see this type of period very soon. And right now, with the monetary easing policies, the S&P 500 being massively leveraged on margin, interest rates being at all-time lows, this really creates a perfect storm for the accumulation of debt. And so I do believe that we are due for a reset sometime in the future, and I do believe there will be massive opportunities for short sellers in the market. Of course, this process takes a long time, and that's what we're currently seeing with the stock market going up and up despite all those deflationary indicators. We have to be patient as traders and look for opportunities as they come. I am convinced it will come in the near future. Now let's check the valuation of the S&P 500 and see if it aligns with this theory and see if the stocks are actually too expensive. Now, before I go on, make sure to like the video if you enjoy this type of content. This type of fundamental analysis video takes a little bit longer to prepare, so don't hesitate to show your support for the channel. Now, the chart you have in front of you is the PE ratio of the S&P 500 since the 1880s. Now, this is actually the Shiller PE ratio, and it's basically adjusted for market cycles. What it basically is a moving average of the actual PE ratio. So I'm going to start off by talking about what the PE ratio actually is. And it's basically the price of a stock divided by the earnings of the underlying company. And so that tells you whether the stock is expensive in regards to how much it makes. And so every stock in the S&P 500 can be put into a range between undervalued and overvalued. And you can see that's what this chart represents. It goes to 0 right here, all the way to 45 right here. And so we can analyze this chart by putting a resistance line and a support line. And what those lines will actually correspond to are the limits where the stock market starts to become overvalued right here and undervalued right here at around right under the 10 PE ratio. And you can see the valuation of the stocks bounces back and forth from the overvalued to the undervalued. And so we see this pattern repeat throughout history. We have to go from undervalued to overvalued, and we need to get back to undervalued before having an actual bull market again. And you can see that's what happened right here in 1980. We went to undervalued territory, and then we had one of the greatest bull markets in history. And so what does this mean for us right now? I believe that the move down back to the undervalued territory is not over with. I believe that this is just a counter rally on an ongoing downtrend, and the stock market is bound to get back to an undervalued territory in the coming years. I believe the bull market that we saw between 2009 and 2020 was not an actual bull market. It did not go from the undervalued to the overvalued range. This was completely funded by the government, by monetary easing policies, by low interest rates, and so basically funded by our very own debt. And when you have unprecedented amounts of money being injected into the economy, into big companies, into big banks, of course the price of stocks goes up. The money supply increases and so prices inflate. That's how things work. And I believe the real issue here is that this bull market was not a result of economic prosperity, but monetary easing policies. And you can see that when we have to repay that debt, the stock market will have to come back to an undervalued range. And you can see that's what happened during the Great Depression. The stock market came back to an undervalued range. And we have very, very similar Federal Reserve fundamentals from 1929. The Federal Reserve was increasing the size of their portfolio during this entire 10-year period, and then stocks came crashing down. And even if you don't buy into this theory that we are in a downtrend and that this is just a counter rally on an ongoing downtrend, well, this chart still speaks to you by the simple fact that we are at very overvalued territory compared to the last 200 years. We are at the same overvalued territory since we were in 1929. And I do not think that stocks will remain forever in overvalued territory. I think they will come back down to reasonable levels. And so that's why I think not only is this a great opportunity for short sellers in the markets right now, but we are also likely to see one of the greatest opportunities to get back into the stock market in a couple years, into possibly some of the most undervalued stocks we have seen in the last 50 to 100 years. And I do believe that that is one way to really build your portfolio, that is to find undervalued stocks, invest in them for the long term, and sell them when they are overvalued. The people who invested right here in 1980 made a lot of money going forward. Same thing here, right in 1932, and same thing here, and same thing here in 1920. And I'm not even going to get into what the PE ratio would look like right now with the US shutdown, with the global shutdown. The earnings of many companies has crashed down, and the price of stocks, the price of the S&P 500 has actually remained pretty steady. And you can see that on the rally from the lows on the S&P 500, we're almost getting back to all-time highs. So the price of the S&P 500 has barely dropped, but the earnings are going to go way, way, way down over the coming months. So on the actual PE ratio chart, because this actually smoothens out the curve, on the actual PE ratio, you're going to get a big, big spike like this, where stocks are massively overvalued compared to their actual earnings, and then it's all going to come crashing back down. I believe that's what's going to be happening in the next couple of years. This is my take on the fundamentals, and I will be increasing the amount of fundamental analysis I put into the channel because I think this is a very important time to do so and to actually be aware of what's going on in the economy. And make sure to leave a comment below if you enjoy this type of analysis, because if that's the case, I'll be glad to go into much more detail in future videos. So I hope you guys enjoyed the video. If you did, make sure to drop a like and subscribe to the channel if you haven't already. And also make sure to turn on your notifications. We often post market updates, trade ideas on the channel, and the timing of those videos is absolutely essential if you want them to be very useful. In the meantime, good luck on your trading and see you next time.